핵무력의 기본 사명은 전쟁을 억제함에 있지만 이 땅에서 우리가 결코 바라지 않는 상황이 조성되는 경우에까지 우리의 핵이 전쟁 방지라는 하나의 사명에만 속박되어 있을 수는 없습니다. 특히 우리 국가가 보유한 핵무력을 최대의 급속한 속도로 더욱 강화 발전시키기 위한 조치들을 계속 취해 나갈 것입니다.
О возможности и допустимости применения против России оружия массового поражения, ядерного оружия. Тем, кто позволяет себе такие заявления в отношении России, хочу напомнить, что наша страна также располагает различными средствами поражения, а по отдельным компонентам и более современными, чем у стран НАТО. И при угрозе территориальной целостности нашей страны для защиты России и нашего народа мы, безусловно, используем все имеющиеся в нашем распоряжении средства. Это не блеф.
Chinese military jets flying near Taiwan this morning, about 60 of them practicing precision strikes on key targets in and around this island. It's part of an exercise that Beijing is calling Joint Sword, which also includes at least 9 Chinese warships that are encircling the island, simulating a naval blockade.
Good morning. We are coming on the air with breaking news. Israel has declared it is at war after a sudden, unprecedented and deadly surprise attack by Hamas this morning. The Palestinian militant group essentially invaded parts of Israel today, infiltrating by land, sea, even air, sending paragliders in. Hamas also launching thousands of rocket attacks, overwhelming Israel's robust defenses, and then sending armed militants into the streets of Israel, some of whom were seen cutting fences at Israel's border with Gaza City to get into the country.
אזרחי ישראל, אנחנו במלחמה. לא במבצע, לא בסבבים, במלחמה.
Iran's foreign minister's comments from only a few hours ago. He basically, I just want to reiterate for people who might just be joining us, he basically said that his country will not remain an observer in the ongoing conflict, that if the scope of this conflict widens, heavy losses will be inflicted on the United States.
To the north of where I am now is on high alert as well. Shelling has been ongoing along the border with Israel. It's resulted in the deaths of a Reuters journalist on Friday and an Israeli civilian just today. And as the world waits to see if Hezbollah will join this war.
The Pentagon announcing the USS Gerald R. Ford carrier strike group is heading to the eastern Mediterranean. Now that includes the Navy's newest aircraft carrier, the Ford, and cruisers and 4 guided missile destroyers.
All right. Today is Sunday, October 15th. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight. Folks, we have a lot to talk about, and unfortunately, it's all serious here. So let's dive right into it. We begin from the Middle East. The conflict is still going on here. And a reminder, just 1 week ago, when the conflict began, I said, remember, that the market is led by robots, aka algos, and they do not care about Israel-Palestine. They care about the bond market being closed, the dollar running out of gas, and oversold technicals. Don't be surprised to see stock futures reversing and turning positive tomorrow. But what do you know? Monday, futures were negative, the stock market closed in the green, and the market continued to rebound into Tuesday, Wednesday, and then I issued another tweet. I said, be careful of being Johnny-comes-lately chasing this rebound. They're going to dump on your head. Severe overbought conditions on the hourly charts. And since Wednesday, we have seen the market going down all the way till Friday. Now here's the problem. Since last week, the conflict in the Middle East has escalated dramatically, and at some point, The market will have to pay attention to this because it's going to become an economic story as well as a geopolitical story. On Friday on Discord, I said, folks, because of the escalation in the Middle East, we see a rush to safety in buying oil, gold, defense contractors, the US dollar, bonds, and puts. This is why we see the VIX popping and many divergences such as gold and the dollar trading higher together. We see bond yields lagging because of the rush to buy bonds for safety before the uncertainty this weekend. And folks, before the Friday session even began, overnight on Thursday, we got the news that Israel is giving warnings for evacuations in Gaza. For what? To begin a ground invasion. And right off the gate, when we got that news, we saw crude oil futures exploding higher. Why? Because those who are shorting oil didn't really want to go through the weekend knowing the news, knowing the uncertainty, being short crude oil. So we saw crude shooting up higher, and then more buying showed up throughout the session. So we saw the move to safety and the defensive formation happening overnight. And then we saw the phenomenon, the divergence here, the rush to safety in buying US dollars, and also the rush to safety in buying gold, silver, and hence the divergence. Usually we have an inverse correlation between gold and silver and the US dollar. But on Friday, both moved higher together because of the rush to safety. In the rush to safety theme, we also see buying of puts over the weekend, because who knows what's going to happen if a ground invasion takes place and then all of a sudden Iran gets involved. So I don't know what's going to happen. I'm going to buy puts heading to the weekend. And we saw the VIX exploding higher, up about 20% in a single day. Now you got the dollar, you got the VIX up. One would assume that bond yields also exploded higher. But on Friday, bond yields were actually tame. Why? Because in the theme of rush to safety, we see also buying of bonds. So a lot of those who have been shorting bonds decided, hey, I got a cover here. We have uncertainty over the weekend. I'm not sure. I'm going to cover my shorts in bonds. And we saw yields lagging the theme of the dollar and the VIX going higher. Now, what does that mean? It means that it could have been an overreaction on Friday, or it could have been a beginning of more defensive formations in the market. And either way, this is going to open a lot of opportunities for us as traders and investors. But there are also developments that took place over the weekend that could clear the way on which scenario we're heading to. Now, to set up the stage, in the beginning we said the market will ignore the Middle East tensions, but as things start to boil up and get out of control, the market will be forced to pay attention. And now the market is giving some attention. If you told me that on Friday the VIX would be up 20% and the market will be down half a percentage point, I would have said, no, come on, there was no way. The stock market should be down 2.5% at least. But again, this is yet another illustration of the market being stubborn to face the facts. The market has been fighting the Fed, fighting the reality of interest rates moving higher, fighting the reality of inflation not really going down meaningfully to the 2% target. And now the market is fighting every geopolitical story, or any political story for that matter, that we get, as it's going to be nothing burger. Why? Because the market now believes that, hey, we have AI and we have plenty of money around and stocks should be going higher. The market continues to fight, but at some point, the market will die by 1,000 stabs. You can't really keep ignoring the facts and what's going on around us for too long. We now see the market beginning to pay attention to the geopolitical risk. And folks, this week we've heard from seasoned investors such as Paul Tudor Jones, who said that the geopolitics right now, the most threatening he's ever seen. When you have Ray Dalio saying there is now a 50% chance of a world war as the Israel-Hamas conflict threatens to spread. When you have the top banker in the country, Jamie Dimon from JP Morgan Chase, aka the Landromat, says and warns that this is the most dangerous time for the world in decades. We have to listen. There's something big going on right now. It began with Russia-Ukraine in the geopolitical arena, and now it's expanding to Israel-Palestine. And now it could expand to include more players and a wider regional conflict, if not even a world war. In that case, the picture of the global economy will become very dire. Now, with all of this happening, we have our own dysfunction here in the political stage in the US. We don't even have a Speaker of the House to pass any bills or any emergency measures that could be needed. They now say maybe Jim Jordan will be the next Speaker of the House. Frankly, I don't think that Jim has the votes, because now we have the Republican Party in dysfunction, looking more as the housewives of DC than an actual functioning political party. You have Matt Gaetz and his allies versus McCarthy and his allies. and McCarthy got ousted now. So when Gates puts out Jim Jordan as a suggestion or a replacement for Speaker of the House, the allies of McCarthy will say no. We're going to go back and forth here until we find a Speaker of the House while the geopolitical stage is burning. And of course, the risk here, the market decided to ignore the risk of the Middle East in the beginning because, okay, we have an attack against Israel. They're going to respond by some aerial bombing. And then just like we've seen back in 21 or 14 or 2009, it's going to end and nothing going to happen beyond that. Now it appears that it could morph, and this is the first time really when we see a real possibility that this conflict could include more and more regional players here. And the number one name that comes to mind is Iran. Now, understand that Iran has proxies in Iraq and now in Syria and in Lebanon with Hezbollah. So they have a direct line all the way down to Israel that they can supply with weapons or military or personnel, whatever is needed here, if this conflict indeed escalates and includes Iran. And if Iran is using Iraq, Syria, and Lebanon to pass weapons or personnel, wouldn't these countries also be involved in the conflict? And this is how things could expand and go out of control. In the last couple of days, we've heard a lot of statements from Iran warning Israel against a ground offensive in Gaza. It appears that this could be a red line for Iran. If it is violated, we could see the involvement of Iran via proxy, for example, such as Hezbollah in Lebanon. A lot of experts say that it could be a game changer if Hezbollah is involved here because Israel will have to fight in two fronts, something that we haven't seen at the same scale before. Bear in mind that Hezbollah is much stronger than Hamas. They have about 150,000 rockets. A lot of them are precision guided, capable of hitting Tel Aviv. The question becomes, what if that actually happens? What would be the involvement of other actors, including the US? We already seen exchange of fires, even death already happened in the northern borders, Israel-Lebanon, between Hezbollah and Israel. And of course, the geniuses of the intelligence community deemed that a wider conflict between Israel and Hezbollah is unlikely, quote-unquote. And that was in February of this year. So we have massive intelligence failure here in Israel and in the US. And I would say, folks, unfortunately, it appears, at least to my eye, that the involvement of Hezbollah is pretty much in the bag now. And of course, it brings the question, what about other players? Turkey. We see Erdogan, for example, urging the Israelis to end the siege of Gaza, describing it as a massacre, criticizing what is the extent of the involvement of Turkey here. On top of that, now we see Israeli airstrikes in Syria, in both Damascus and Aleppo airports. Now, okay, if Israel now bombing Syria, will Syria respond? Will Syria become involved in this conflict? And a reminder, Syria is pretty much a client state for Russia. We have thousands of Russian troops in Syria. If Syria retaliates, for example, bombing Israel, and Israel retaliates based on that retaliation and bombs Damascus and the rest of Syria in a more inclusive way than we've seen before, what would be the response of Russia? Will Russia just stay out of it and watch their client state getting bombed? I don't think so. And that, of course, leads us to the involvement of the United States. You know, when I read the headlines that we have the Gerald Ford moving to the Mediterranean, I thought that was an overreaction. Wait a minute here. We're moving the largest ship that we got in response to a group, not even a country, a group, Hamas. 30,000 fighters tops in flip-flops and homemade weapons? I don't know. It seems like an overreaction to me. And after that, we heard the news that the Joe Biden administration is sending another ship, the USS Eisenhower. So two of the largest ships in the capacity of the United States military in response to Hamas? It doesn't add up here. Either it's a case of overreaction and an embarrassment, really. You should reserve that kind of card for a bigger adversary, be it China or Russia, not Hamas. Or do we have some intelligence here that the possibility of the conflict escalating and including more players, namely Iran or possibly Russia? Is this why we're sending 2 aircraft carriers to the region? Because to me, this looks at least as a preparation for war. The other risk, of course, comes from the public opinion. Forget about the media. We're talking about the public, not just here in Europe, in the Middle East. You can see in the matter of a week, it's really amazing to watch. The public opinion made a 180 from being absolutely empathetic to the atrocities that took place in Israel to now focusing on the atrocities taking place in Gaza instead. We know that it's been under a blockade for years now. And of course, the Israeli government decided in reaction to the attack that took place last Saturday that they're going to cut off the gas, water, fuel, electricity to the Gaza Strip. And of course, now it becomes a humanitarian disaster, knowing the fact that at least 50% of the population in Gaza are children, and they've been already facing shortages of food, electricity, water, facing poverty, and the adults, about 50% of them facing unemployment. So the situation was dire to begin with. Now it's becoming even more dire, and this is shifting the public opinion dramatically in the last few days, but specifically in the Middle East. Now, you might have heard the fake headlines that the Emir of Qatar came out and said he's going to cut the supply of gas to the world if the conflict in Gaza doesn't stop. Now, this is fake news, but there is a point to be made out of it. What if the ground invasion of Gaza takes place and we see absolutely horrific pictures of children getting killed more than what we've already seen? Then maybe the temperature in the streets of the Arab countries will start to boil and add pressure on governments to do something. Now, we remember what happened back in the 70s during the Arab-Israeli conflict. We got the Arab oil embargo, which was one of the main culprits for inflation in the stagflation crisis that we've seen back then, when energy prices exploded out of control. What if this scenario takes place in this conflict? What if we see the oil embargo 2.0? Don't say that that's a far-fetched possibility, because it could be reality before you know. It's all about the public opinion. It's all about the temperatures and the pressures these governments will feel if the conflict escalates. Suppose Saudi Arabia comes along with Iraq and UAE and Kuwait and maybe joined by Iran or even Russia in cutting oil supply as a political statement. In that case, we're going to have about 20% of these supplies being shut off. That's going to have a significant economic impact globally. We will see oil prices exploding higher, perhaps beyond $150 a barrel, if not over $200 a barrel. And the same can be said on the natural gas front. We know that Iran has the largest reserves of natural gas in the world. When it comes to the production of gas, Australia is number one, but it's at capacity right now. Then you have Qatar. And what if Qatar indeed cuts the supply in a coordinated move with other Arab nations? That is a possibility, and that's going to paralyze the supplies of natural gas. You also got Algeria, which is supplying a lot of gas right now. What if Algeria joins a boycott and shuts down the supply of gas? We know since the Russia-Ukraine war began, European countries had to diversify their resources of natural gas away from Russia, and Egypt, Algeria in particular, came as an alternative. According to the European Union's own numbers, when we look at petroleum oil, the imports, the majority of them come from Norway and the US. Of course, we have the other category. Who knows what others really mean? Is it Iranian oil? Is it Venezuelan oil? Is it Russian oil sold as something else? Who knows? But when it comes to natural gas, about 16.5% of European nations' imports of natural gas is coming from Algeria. When it comes to LNG, liquefied natural gas, of course, the majority is coming from the US now, replacing Russia. Win for the United States, of course, but a huge percentage, about 11%, comes from Qatar, and about 10% comes from Algeria. What if these two countries coordinate a move with other Arab states and say, okay, we're going to cut energy resources to the world until the conflict is over? That could cause major disruption to the global economy. So this is the risk that we have. And we're just beginning here. But we have to talk about who are the losers and the winners from this conflict so far, because all of this will have major economic consequences. When we think about the losers, right off the gate, the number one name comes to mind is Bibi Netanyahu, the Prime Minister of Israel. To begin with, the Israeli shekel, the currency of Israel, has been crashing before the conflict even began, now sitting at the lowest level since 2015. And of course, the war now exacerbated that move. When we look at Israeli credit default swaps, they have exploded higher since the conflict began. Not just the Israeli, but a little bit in the Saudi CDS and Qatari CDS. But in Israel, it's a huge move, and it indicates massive economic risk here. With a currency in free fall, with a stock market that is crashing, and now the possibility that higher rates in Israel will cause a major credit event. So we see the rush in buying insurance in a stunning way here in the CDS. But you have to understand that Bibi Netanyahu been under pressure even before the conflict began. We have seen massive protests in Israel against Benjamin Netanyahu, describing him as a dictator, a threat to democracy. We've seen scenes in the streets with thousands and thousands of protesters all over the place, demanding the resignation of Bibi Netanyahu, demanding, some of them at least, for him to face trial and end up in jail, because part of his agenda was changing the balance of power in the judicial system in Israel. Now, a lot of folks did not like that, and we saw massive protests. And then, of course, came the attack from Hamas, which is the biggest security failure in the country of Israel in about 50 years. Some would argue this is the biggest intelligence failure since 9/11. Hamas obviously was able to penetrate inside Israeli intelligence and dupe Israeli intelligence and create the most devastating attack in a long time. Of course, Netanyahu might have felt some relief that the attention will be shifted from him as a villain to perhaps a hero as he fights against Hamas. But unfortunately for him, he keeps making bad decision after bad decision after bad decision. And now we see that the Israeli public opinion is now turning against Netanyahu once again, blaming him for the security failure and blaming him for the hostage crisis, implicating that Bibi Netanyahu failed to protect the citizens of Israel. And of course, the other failure comes from perhaps the knee-jerk reaction. Immediately, instead of thinking about the hostages and how to secure them out of Gaza first, and then deal with Hamas. Maybe there was a knee-jerk reaction without thinking here, without planning, that not only shifted empathy in the public opinion away from Israel toward Gaza when they decided to shut off water, electricity, gas, and even food and medicine to the civilian population in Gaza. And you see it happening, not just in the streets. You see it happening even in the U.S. media and the reaction by the U.S. government, one step at a time. I was watching CNN State of the Union. I was kind of shocked to see a propaganda CNN asking some hard-hitting questions here. But it shows how the public sentiment and the opinion began to change. And even propaganda CNN is now reflecting all of that. Take a look.
No higher priority than getting Americans back safe, Americans who are being held hostage by Hamas.
The Israelis are bombing the crap out of Gaza, Jake. I mean, it doesn't seem like saving the hostages are a priority at all right now. Again, Hamas is vile. What they did 8 days ago, they're targeting civilians. It's horrific. But what's going on right now is not just a punishment of Hamas. More than 700 children have been reportedly killed in Gaza. And obviously, electricity, food, water supplies have been cut off by Israel to the totality of Gaza. Obviously, the blockade is not just by Israel, it's by Egypt too. Take a listen to what Secretary Blinken said last year when Putin was targeting Ukrainian infrastructure.
Heat, water, electricity for children, for the elderly, for the sick. These are President Putin's new targets. He's hitting them hard. This brutalization of Ukraine's people is barbaric.
Now look, Israel is not Russia. Gaza is not Ukraine. It's a different situation. But cutting off supplies, cutting off heat, cutting off water to civilians, what's the difference?
And for myself.
But you're not telling the Israelis to let the Palestinian hospitals have power.
Now, Jake Sullivan, of course, he's going to do his job, just read the predetermined and pre-written statements, say the same crap over and over and over again. But behind the scenes, and you see that he's kind of struggling to answer questions here, because behind the scenes, of course, the Secretary of State Blinken went over to Israel and said, we support Israel all in all, through and through, no matter what, we're going to do whatever it takes, yada, yada, yada. Behind the scenes, privately, Blinken went to Netanyahu and the Israelis and said, okay, what is the plan here? What are you doing? Do you even know what you're doing? Is there an exit strategy here? Because it doesn't seem like you have one. It seems like you got a knee-jerk reaction, and now you're stuck. You managed to turn the public opinion against Israel now. So Blinken goes on in a diplomacy tour all over the region now to coordinate something and see the fears that the market had on Friday that a ground invasion will begin over the weekend. Now those fears are subdued because Blinken goes over there and said, hold your horses. I don't think you know what you're doing here. And all of a sudden we see the ground invasion delayed, at least for now, until more measures are taken. And I'm pretty sure it was the Biden administration, led by Blinken, who convinced the Israelis to halt for a little while, issue warnings for the population in Gaza, restore some water supply. All of these are efforts done by Blinken because behind the scenes, the State Department believes that Bibi Netanyahu has no idea what he's doing right now. And of course, there is the story that perhaps Israel was tipped off about the attack by Egypt 3 days before. Whether the administration decided to ignore that or maybe not take it as seriously, who knows? But all of this is going to come back and haunt Bibi Netanyahu. I think the man is toast. He's over. It's done. The biggest loser so far. The other loser is the Saudi-Israel deal. Now, one day, literally 1 day before the attack took place last week, which again, I don't think this is a coincidence. I think the timing really important here. We got the news from the Wall Street Journal that Saudi Arabia is willing to raise the oil output to help secure Israel deal. Meaning, we got a deal with Israel that includes a security pact with Israel, with the U.S. And okay, we're going to increase the supply of oil and reduce the price of gas at the pump for Americans and maybe help the Biden administration win politically as we head deeper into the election season. And of course, fast forward 1 week later, here's the headline from Reuters. Saudi Arabia puts Israel deal on ice amid war engages with Iran instead. We'll talk about that in a minute, but it is now clear that all of the optimism that oil prices will go down because we have a deal between Saudi and Israel sponsored by the Biden administration, all of these hopes are now gone. And we see the price of oil rebounding, almost erasing all of the losses from that headline. And now we're hearing more and more news that it takes one miscalculation here in this conflict that we're seeing in the Middle East to create the next world oil crisis. And I think it's going to happen via the Arab embargo 2.0, depending, of course, on what we're going to see in Gaza, whether we're going to have a ground invasion or not. And of course, the other loser is the Federal Reserve led by Jerome Powell. And the reason is oil prices are now moving higher again. And you'll see in our coverage of the CPI and inflation in a minute that if gasoline prices go higher, the CPI is going to rebound dramatically higher. And this makes all of the hopes and the talks about Goldilocks and soft landing by the Fed, all of these hopes will go kaput. They're done. And now, certainly, we're going to have a hard landing as the Fed is forced to raise rates even higher. And if that is the case, the other loser would be the stock market. The stock market been dismissing everything and moving higher because, okay, whatever is going on around the world is noise, with exception of two things. AI, and the other thing is inflation is going down. Sure, it's not going down to the 2% target, but it's cooling off. And that backs off the Federal Reserve. It cuts the possibility of higher rates from happening. And this is one of the major catalysts behind the stock market rise this year. If you take that away, the market will find it really hard to move higher and ignore the fact that inflation is coming back because of energy prices coming back due to the geopolitical risk. And if that is the case, again, one of the biggest losers so far is the Joey B administration. On the foreign policy front, they've lost one of the most important agenda here that they've been planning for months, the Saudi-Israel deal. That's not going to happen, not anytime soon, probably never, because part of it was Saudi Arabia is looking for security and an alliance with Israel, a country known for prestigious military and high capability of intelligence, was part of the incentive here. Now that we've seen a massive intelligence failure in Israel, failing to protect their own population, is it really incentive enough for the Saudis to do the deal at this point? Of course not. And that would be a massive failure for the Joe Biden foreign policy agenda. On the economic front, Joe Biden also loses because there was a lot of hope that inflation is going to go down, and by 24, we're going to see a recovery in the economy, inflation subdued, and we start to see growth picking up. Now, this possibility becomes more grim, that inflation will stick, if not move higher, and it will take the Federal Reserve to do more to tackle this inflation and reduce demand even more by pushing the economy into a recession prematurely and rapidly, before the election even begins. Now, when we talk about the winners of this conflict so far, of course, the number one winner is Hamas. They've managed to breach the security and intelligence of Israel and commit atrocities, bring back hostages, and then what? Flip the public opinion back against Israel as the world watches buildings and children and innocent folks in Gaza getting killed too. There was also talk about perhaps Hamas infiltrating Israeli intelligence and the military by having prior knowledge of deeply held secrets. How did they know that? How did Israel fail? By allowing all of this stuff to leak. Another winner is Iran. We talked about the Saudi-Israel deal being kaput. Who's the replacement now? It's Iran. In an unprecedented move, we heard the news that the Iranian president spoke to the Saudi Crown Prince MBS for the first time since ties restored by China. Major win for Iran here. Not only the Saudi-Israel deal is stopped, oil prices stay higher, number one. Number two, they emerge as a regional power. Not just from a military standpoint, but also from a diplomatic standpoint. The Iranian foreign minister was in Qatar, was in Lebanon, soon enough Jordan, Egypt, and now Iran becomes a major key to either escalating or solving this conflict. And this is the kind of power that Iran didn't have before. Another winner, of course, safety havens. Be it bonds, be it gold, be it silver, but specifically gold. We have seen a stunning move in gold in Friday's session. The moment we heard about a ground invasion, the rush to safety in buying gold was absolutely stunning. And the question now becomes, after the diplomacy efforts by Blinken in halting the ground invasion for a little while, will gold lose its allure? Will we see gold moving down, or will the dips be opportunities, at least looked at as opportunities to buy? If it is the latter, then the market mode will still be the rush to safety, defensive, and that will cause equities to suffer, as money comes out of equities to buy the dips in gold. If gold fades away right off the gate Monday, then we're going to know that the market looks at it as, okay, things are de-escalating right now, and my focus will be shift to earnings, not the geopolitical risk. Another winner so far is inflation. We know what's going on with crude oil prices. Right off the gate on Friday, we got the headline that we have tightening of sanctions against Russia, and oil prices went higher. And of course, when we heard about the ground invasion possibility, a lot of shorts covered. All of this points out that oil prices are going higher. And those folks who've been saying that $100 a barrel or more coming before the end of the year as a real possibility, perhaps they don't look so dumb after all. And the rise in crude oil will feed across the entirety of the economy, causing more and more inflation, to the point where a European Central Bank member says that oil price shock could spur another rate hike. Now it becomes real for financial markets. You see, financial markets care about the Fed, central bankers, and the path of interest rate hikes. If the market can see that interest rate hikes are done, and from this point on we have peaked, or we're going to see rate cuts coming soon, then the market has the ability to ignore all of these geopolitical problems, at least attempt to ignore them. But if these geopolitical events spill over to become economic events, and in reaction to that we see central banks hiking even more and tightening the monetary policy even more, then the market becomes really concerned about that. And it's not just crude oil. If we look at the natural gas front, we got the news that Israel ordered Chevron to shut down a major natural gas field in the Mediterranean that was moving product to Egypt for refining, and Egypt was exporting all of that natural gas to European countries. Well, guess what? When Israel ordered the shutdown of this field, guess what happened? European natural gas futures exploded higher. A massive, stunning move in a matter of days. We have also seen fertilizer and grain prices moving higher this week, albeit not as impulsively as oil and gas, but again, it highlights the risk here. The ports in Israel, major exporters of fertilizers, and of course Iran happens to be one of the major exporters of fertilizers too. A wider conflict could push food prices significantly higher. We know what's going on in Ukraine. Fertilizer is not coming out of there as reliable as we've been getting before the war. Russia cannot really cover everything. Australia cannot really cover everything. So you add to Ukraine a disruption of supply from Israel and Iran. It could be a major problem here. Now, of course, all of this comes on top of the beats that we've seen this week from the PPI, the Producer Price Index, and the CPI, the Consumer Price Index, all beating expectations higher, indicating that inflation is coming back and moving higher, away from the 2% target of the Fed. If we look at certain categories, such as the change in services, ex-housing and energy, also known as supercore inflation, which Jerome Powell highlighted before, that's moving higher. Not just higher, but to the highest level since last year. So to say that the inflation fight is over, it is way too premature. The inflation risk is still here, and it's actually moving higher and higher and higher by the day. And the conflict in the Middle East is just exacerbating all of that. When you look at the CPI, the Consumer Price Index, the change since 21, you can see that food prices are not going down, all items are not going down, core inflation is not going down. The only reason the headline of the CPI went down in prior months is the decline of gasoline prices. Now, when we see gasoline prices moving higher again, the expectations are the CPI should recover and move higher. What would be the response of the monetary policy? The answer is higher rates. The only way you can see or say with certainty that inflation is going down if you take the Paul Krugman approach of taking CPI x everything. Then sure, inflation is cooling. Otherwise, inflation is going higher. And even the IMF is now admitting that inflation will not slow as much as previously anticipated. They see inflation sticking here all the way through 2024. And as inflation moves higher, interest rates move higher, and we see that the grip choking the American consumer right now is being tightened as interest rates move higher. Why? Take, for example, the average interest rate for a 4-year new auto loan. That is moving to the highest level since 2005. Higher than what we saw back in the financial crisis of 2008, 2009. And we know that consumer debt is exploding higher, way higher than the GFC. And of course, as debt increases higher, it is facing higher and higher rates. The consumer is being choked right now, and this is forcing them to take more jobs. So when the propagandists and the pumpers in the media say that, oh, the economy is fine, we're going to have a soft landing because look at all of these jobs we've been creating in the economy. Well, a lot of these jobs are second and third jobs, as folks cannot really cope with the increase in living cost. They racked up more debt, they have to pay their student loans now, all at a higher rate. Okay, so when the consumer is forced to slow down spending because rates are going higher and they have to be busy paying their debt, whatever they make, they have to pay their debts now, not consuming the economy. What happens to corporate revenues? They go down. At the same time, corporations will face the increase in cost too, the increase in energy costs, which means that margins will collapse. In response to that, corporate America will have to lay off a lot of employees. So all I got to say is tick-tock. The recession is near the corner now. One thing breaks, one thing snaps, and then the entirety of the economy comes down crashing together. When we talk about the risk of higher rates, look at the mountain of debt that we have in this country right now. Trillions and trillions of dollars. And all of these trillions and trillions of dollars are no longer holding a AAA rating. So now we talk about the systemic risk. And it doesn't appear that inflation will cool down anytime soon. We talked about auto workers, while the Detroit auto workers are the highest paid across the world. At the same time, they haven't seen an increase in their wages since this inflation began. So they've been lagging all workers in the economy when it comes to wage growth versus the rate in the growth in inflation. And the auto companies will have to capitulate at some point and pay these workers higher wages, and to compensate for that, they have to raise the prices of new cars, another major component of the CPI. So again, if you think that CPI inflation is cooling and it's done, you better think again. We have a lot of factors that will push fuel and energy prices higher, and that's going to feed into the economy. We have wages, which will push the price of new cars higher. And by the way, the latest reading of the CPI showed that shelter inflation is now re-accelerating again. We're not heading toward the right direction here. And that leads us to the market commentary. If bond yields are going higher, then you've heard the Fed throughout the week, and the Fed been saying for a long time now, oh, we're done. No, we're going to pause. We're going to be data dependent, blah, blah, blah. But one thing the Fed is doing right now is, oh, we can afford to do nothing because bond yields been moving higher on their own because of exogenous reasons such as the supply and the risk of default, the reckless fiscal policy, the Bank of Japan. So we don't have to do anything here. The bond market is doing the tightening for us. We can see that financial conditions moved higher. Now here's the risk for the Fed. The Fed says, okay, the bond market is doing the tightening, but you're going to start to see that the shorter end at some point will also begin to move higher. The shorter end of what? The shorter end of the yield curve, meaning the 2-year yield will start to move higher. And the Fed always follows the 2-year. In other words, the Fed can play the game and say, okay, bond yields are doing the tightening for us, so we can afford to do nothing right now. But at some point, they're going to have to play catch up. And this will be proven as one of the many mistakes that the Fed has done so far. And then what do you think will happen? Financial conditions will tighten even more. And this is going to force the equities market to go down even more. As we begin to see the risk premium for the S&P 500 for the stock market the worst in over 2 decades, it's not really worth it to hold stocks anymore. We see that the 10-year yield is now about to exceed the forward yield of the S&P 500. It is not worth it to hold stocks anymore. Why would you do that when you have the safety of bonds getting 5.5%, 6% with no risk involved? A matter of fact, the headline reads, the last time U.S. stocks were this pricey relative to the debt market, the S&P 500 crashed by 50%. What are they talking about? Here it is. Equity risk premium is near its worst ever level going back to 1927, and previous such instances gave trigger to major market corrections. So again, we talk about 1987 all the time here. We talk about 2009, we talk about 2000, and now we're talking about 1927. We're not in good company here. All of the correlations that we see are with bad years, not good ones. And now as we see the yield curve moving away from inversion to steepening, that's when the trouble begins. All the time. That's when we saw the crash of 2008 and the recession in 2009. This is when we saw the crash of 2000, the recession in the 1990s, the recessions and crashes in the 1980s. And could this time be different? Sure. But would I bet on it? Of course not. We now see that corporate credits, the spreads are now widening by the most since the collapse of SVB. In other words, the systemic risk is now increasing for the first time since the collapse of SVB. You see, I told you before numerous times in this channel that the market and the economy decided to ignore the collapse of SVB because the Fed will come to the rescue and everybody's going to live happily ever after. But I told you that the collapse of SVB is the appetizer to what's about to come, and it's inevitable. It's unavoidable. And now we see the beginning of this systemic risk being factored in back into the equation. And when we talk about this so-called bull market, and I say that sarcastically, it's a bear market. Everybody with a brain knows that. When we look at the percentage of S&P 500 stocks above the 50 days moving average, less than 25%. These are the same readings we have seen back during the collapse of SVB and what we have seen back when the market was dropping big in the third quarter of 2022. When we look at the S&P 500 stocks hitting new 52-week intraday lows, we see that this number is now surging higher. We have more stocks hitting 52-week lows than we've seen before. And these are not the markings of a bull market. When we see the S&P 500 outperforming the equal weight S&P by the widest margin since before the market crash in 2000, are we really in good company here? What does that say when the equal weight index is lagging by a lot? It means that we have a stock market rally based on a handful of names. And these handful of names, 7 stocks, aka the Magnificent Seven, aka the AI mania, they're now holding almost 30% of the weighting of the S&P 500. So we see the index, quote, in a bull market, end quote, because of the weighting of these stocks. But the rest of the market is crashing as we speak right now. We saw that the stock market decided to ignore all of these factors, including liquidity. Why? Because of NVIDIA and the AI mania. Everybody decided to ignore all of the indicators that we've been accustomed to for years now, including Fed's liquidity, which is dropping, not going higher. Yet the market decided to say, I don't care, because AI will beat everything out there. So we see the NASDAQ breadth, for example, in red, crashing. The stock market should have been negative this year in a crash, and it only avoided doing so because of a handful of stocks with a lot of weighting on the indices. And these handful of stocks are moving higher because of 2 letters, AI. But these stocks are also about to face the music here. Their price-to-earnings ratios are not looking pretty good. They're all expensive. But we see that since the top in July, even technology has been underperforming along with the majority of the stock market, with exception of energy. And of course, now we're heading into earnings season, and the expectations on those 7 stocks are really, really high. It becomes pass or die. Either you can meet these really high expectations, beat revenues, beat earnings, show massive growth in the top line and the bottom line. Otherwise, these names will begin to stumble, and they will take down the entirety of the stock market with them. They took it higher, they kept it higher, despite all of the risk that we see around us, and they will be the ones that take it down and crash it once and for all. What we got so far from earnings, at least from banks, we continue to see that non-interest-bearing deposits leaving these banks. If you have your money in a bank and you're not getting any interest rate on it, at least not a competitive interest rate, you're leaving. You'd be stupid not to leave. You got money market funds paying you over 5.5%. You got CDs paying you over 5.5%. You got risk-free bonds now paying you 5% plus. If the bank is not paying you a competitive rate above the risk-free rate, you gotta be stupid to keep your money in the bank. And as deposits flee, we begin to see more and more trouble in banks. And now a lot of them, at least the big ones, have to preserve these deposits by paying customers higher and higher interest rates, more competitive rates. And this is going to add a lot of pressure on these banks. They can pass 1 report, 2 reports, 1 quarter, but sooner than later, they're going to have to face the music here, that to stay competitive with the risk-free rate, they have to raise these interest rates that they pay for depositors by much higher. And at some point, they cannot really compete with the risk-free rate. It's impossible because they're not generating as much revenue. The economy is weakening. Loan growth is weakening. So where will the money come from to pay depositors more? That is the systemic risk that we see right now. And of course, this week, We're going to begin with one of the Magnificent Seven when it comes to earnings, and that is Tesla. And already right off the gate, we see bad headlines showing up. We know that Tesla's now reducing prices pretty much by the day. At some point, they might just give them for free. And the reason is we see that demand for Teslas, at least in China, the volume is down around 11% year on year. And now Tesla's resorting to doing ads to increase demand. This is a desperate move that will cost Tesla a lot of money, reduce the margins even more. And it's an indicator that the company is facing demand problem. The company is facing market share problems with competitors. Now, this stock Tesla happens to be widely held among the retail investors. And if it goes down by a lot, then it's going to sour the sentiment in the stock market by a lot. And we're going to see a lot of folks saying, okay, what happened to Tesla might happen to Apple or Microsoft or Nvidia. I'm going to cash out here and avoid the headache. And if this is the sentiment that is created after these earnings, mainly from Tesla, then buckle up here. We have more and more headwinds, not just from the geopolitics, not just from the inflation front, not just from the interest rate front, but now also from the earnings front. Can you really have anything else here left to hold the stock market if we lose earnings? You can say AI all you want. It's not going to do anything here if earnings begin to contract, if margins begin to collapse. Now, before moving on, let's review the morning brief to set up the stage for the stock market this upcoming week. And this is the morning brief from Friday. And I said, good morning. The overnight retreat in the dollar and bond yields are allowing stock market indices to rebound. But that might not be the case throughout the day. So let's identify some numbers and patterns to watch. The Dixie, the 1 hour. The bearish scenario if the consolidation in the chart overnight is meant to release energy to the upside. We will know that if the chart trades above 106.522 from an hourly basis. On the other hand, in the bullish scenario for the stock market, is if the dollar stalled here and about to lose ground. We can confirm that if the dollar loses 106.196 as support on the hourly chart. And I gave you these charts in the morning. This would be the bearish scenario for the stock market if we see the dollar moving higher, above 106.522 on the hourly chart. On the other hand, had we've seen the dollar losing 106.318 as support, then losing 106.196 as support, we got a confirmation that this is the bullish scenario for the stock market and we have a rally coming. What did we get? We got the bearish scenario. The Dixie on the hourly chart moved higher above 106.552, and hence we see equities moving down Friday. We go back to the morning brief. On the 10-year yield, I said on the hourly chart, the bearish scenario for the market if the pullback overnight is a part of an ABC pattern. We will know that if the chart rebounds before reaching 4.575% and trades toward 4.688%. On the other hand, the bullish scenario for the market takes place if the chart loses 4.575 as support on the 1 hour time frame. Now, I provided you with these charts. This would be the bearish scenario for the stock market if we see an ABC pattern in the 10-year yield and we see it trading above 4.688 basis points. And this would be the bullish scenario for the stock market if we see the 10-year yield moving below 4.575%. Here's the update, including today's session, and you can see that this was inconclusive. We did not get the bearish break or the bullish break, one way or the other. My hunch is yields should have been higher, but we saw a rush to safety on Friday's session. This is why we saw some buying of bonds. So the 10-year was moving higher, but it was tame. It lagged the dollar and the VIX. But again, we have the three indicators that we watch every single day: the Dixie, the 10-year yield, and the VIX. We got a bearish signal from the dollar. We got a neutral signal from the 10-year. What did we get from the VIX? We go back to the morning brief, an hourly chart. The bearish scenario for the market if the chart is consolidating in an inverse head and shoulder pattern. We can confirm that if the chart maintains 16.5 as support and trades above 17.54 on a 1 hour basis. The bullish scenario for the market would be if the VIX loses ground by trading below 16.5, which is the shoulder line with the 1 hour time frame. Now, I provided you with these charts, an hourly chart of the VIX. If we see the VIX below 16.5, you know that this is the bullish scenario for the stock market. If we see, on the other hand, that 16.5 is held as support, and then we see the VIX moving higher above 17, then understand that we have the possibility of the inverse head and shoulder pattern, and that would be bearish for the stock market. Here's the update, what we got. The VIX, of course, maintained 16.5 as support, and it moved above 17, and then we saw the massive explosion higher. So now we got the dollar and the VIX as bearish indicators. The 10-year was neutral, but this was enough to pull equities down. Now, of course, we're going to have another morning brief tomorrow. So if you're interested in this kind of stuff, please join us. You're going to see a join tab in the channel here. Click join, choose the tier that you like. And if you choose to be in Discord, there is a link in the description of this video. Follow the link, you'll be synced automatically into Discord, and you will see a channel called The Morning Brief on my Discord. I issue all of the morning briefs in that particular channel. And folks, let's just say this, at least since the second half of this year, we've been nailing the market action day by day. Nobody else is doing it this way, to this level, and this magnitude, day by day in these morning briefs. So again, if you're interested, consider joining. But folks, let's expand the conversation here a little more and cover the market information that we got on Friday and see where we go from here. We begin with the closing of the indices last Friday, and here we go. The Dow Industrial Average on Friday closing positive by 39.15 points, or a gain of 0.12%. The Nasdaq deep in the red, leading the losers, down by 166.98 points, or a decline of 1.23%. The S&P down by 21.83 points, or a decline of a half a percentage point. We look at the sectors on Friday. Leading the pack at number 1, capturing the gold medal, energy. That's inflationary, and that's geopolitics related. And then we have at number 2 for the silver, utilities. And number 3 for the bronze, defensives. What's up with that? Well, when bond yields are now moving higher because we have a rush to safety in buying bonds, all of a sudden these yield-sensitive names, utilities, defensives, healthcare, they move higher. It's also part of the defensive formation that we got on Friday. The laggards, technology, cyclicals, and communication services. Part of the offensive theme, so we saw some de-risking here on Friday by dumping the big caps and technology, raising some cash to do what? Either wait in the sidelines, maybe buy gold or oil. Of course, things will change as we head into a new week with new developments. Yet when we look at the week all in all, it was positive, believe it or not, led once again by energy, the inflation sector, and the geopolitics sensitive sector. Utilities, real estate, number 2 or 3, because bond yields did not do a lot this week. They were muted, they were closed to begin with on Monday, and then we saw the rush to safety in bonds, and we saw a muted and neutral reactions by bond yields, so we saw utilities and real estate moving higher. We look at the breadth on Friday, a little better than Thursday, believe it or not, and the reason is the big caps were down, so we saw the indices down, but the breadth all in all was actually a lot better than Thursday. NYSE 36% advancing versus 62% declining. The Nasdaq 35% advancing versus 61% declining. So all of a sudden now we're back to the rotational market where we have seen money coming out of the big caps and chasing the dips in yield sensitive sectors such as utilities, defensives, real estate, and healthcare. And of course chasing the geopolitics related sectors such as metals, in specific gold and energy, and of course the defense contractors and industrials. Is that going to last or not? It all depends on the development that we see in the Middle East. And for now, we have at least a delayed ground invasion. That's where we stand right now. But things are about to move really fast. We move on to commodities, and this was the closing on Friday. The dollar was up a little bit, but it was part of a larger move in the rush to safety by buying the US dollar and also buying oil. Nobody knows what's going to happen over the weekend. We have news about ground invasion. So we saw the WTI and Brent up a little over 5.5% apiece. Massive gains on Friday. Gasoline RBOB up almost 5%. Heating oil, aka diesel, up almost 5.5% on Friday. The laggard was the winner last week. Natural gas was down about 4% on Friday. In metals, the rush to safety, we saw massive gains in gold, north of 3.25%, silver, north of 4.25%, platinum also managed to gain a little over 1.25%. But we see copper down. Copper is the offensive, the risk off, but copper doesn't like when the dollar goes higher. So if we have a rush to safety in buying the dollar, if it is part of a larger theme, then sure, we can see gold and silver defying the correlation with the dollar and moving higher along with it. But copper cannot say that because copper is not part of the defensive theme. And of course, when we look at softs, we continue to see that prices are going higher, be it in cocoa, cotton, OJ, coffee, lumber, sugar, all positive on Friday's session. When it comes to grains, mixed picture here, but we saw sizable gains led by soybean oil, up a little over 2%, and then you have wheat futures also up about 1.5%. My expectations are if we see Iran being involved in this war in the Middle East, and we see disruptions in fertilizer supplies, along with what's going on in Ukraine to begin with, we could see grain prices moving even higher. And when we look at the week all in all, the winners, led by heating oil, up about 10.5%. Then we have Brent oil, up a little over 7%. We have coffee, massive gains, worth about 6%. The WTI lagging Brent by a little bit, yet managing to pull gains worth about 5.5%. And then we have gold and silver, up about a little over 5% apiece. The laggards, led by oats, down about 10% for the week. Lean hogs, down about 5.5%. And of course, natural gas, down about 4%. The majority of the declines in natural gas came on Friday, but this comes on the heels of gains in the prior week. We move on to the big casino, the options market. What do we see here? The volume is recovering, but we see what? We see a retreat in buying calls, a more buying of puts on Friday's session. So now all of a sudden the traders say maybe the rebound is on shaky ground here. Maybe it's over. Maybe we'll go down from here. Maybe we're going to form lower lows. Maybe the rebound was just a mere rebound in a larger bear trend in equities now. So we see buying of puts. Of course, the fears about geopolitics add to all of that. But understand we got really bad readings in the PPI and the CPI reinflation this week. And that has to be part of the calculus too, that bond yields are going higher, that the dollar is going higher. At some point, it becomes just too much. And you're going to need the protection here in buying puts, especially as we head to the earnings season. We move on to the unusual activities that took place in the options market on Friday. We begin with the ticker GLD for gold. Now, I talked about this on Friday in the live stream. I said, look, I might be shorting GLD here because there is a pop on Friday, and the pop is happening in defiance of the dollar going higher. Why is it happening? The assumption that we have a ground invasion and a lot of problems as we head to the weekend. It's part of de-risking. But then on the other hand, was the move excessive? I would say yes, considering the divergence from the dollar and considering the possibility that the ground invasion could be halted for a little while. So it is no surprise here that on Friday we saw some more bids coming in, betting that gold will go higher. And again, I would take the opposite side at least Monday, and then we see what happens. But here we have a trader who bought the 188 call for the expiration date November 3rd with expectations that GLD will move higher and gain more than 5% by the expiration date. They paid about 75 cents a piece to enter this trade, all in all spending about $750,000. And then we have a call spread for the KRE. Now on Friday we got some big bank earnings, and they were okay. Of course, the devil is always in the details about deposits and what's coming down the line. But earlier on Friday, we saw the KRE regional banks also moving higher, along with the big banks. But then they gave up and they turned negative. I see that as relative weakness here for the regional banks, but if you want to play an upcoming upside, if you see it at least, in regional banks, the KRE, you might want to follow the trade right here because it is disciplined and you're not going to spend a lot of money using this structure right here. Somebody bought the 42.5 calls and they sold the 45 for the expiration date November 3rd. They paid about 50 cents a piece in buying the 42.5 calls, received about 25 cents a piece from selling the 45 calls. All in all, the entry cost is reduced to about 25 cents a piece, and they spent about $250,000 for this trade. And then we have the ticker USO. This is for the United States Oil Fund. So it goes higher when crude oil goes higher and somebody sees big gains to come here. They bought the 85 calls for the expiration date, November 17th. Expectations, the USO will move higher and gain more than 7.5% by then. Paid about $2 a piece to enter this trade, all in all spending about $1.5 million. And then we have the ticker BAC for Bank of America, a name, reporting earnings this week, I believe Tuesday, and the chart doesn't look pretty good. I think that BofA is a lot weaker than JP Morgan, and somebody sees declines to come here. They bought the 25 puts for the expiration date, November 24th, with expectations, the BAC will go down and lose more than 6.5% of its value by then. Paid about 50 cents a piece to enter this trade, all in all spending about $350,000. We move on to the heat map on Friday. What do we see here? The theme is really interesting here because we see the majority of de-risking coming from the winners year to date. So we see the big caps lagging, be it Microsoft, Apple, Meta, Google, Amazon, Tesla, all down. The AI mania in chips, be it Nvidia, was down about a little over 3%. AMD AMD was down about 3.5%. Broadcom was down. Software was down. Adobe was down. The winners in industrials, be it Eaton, be it FedEx, be it a lot of the transportation names, went down. And where did the money go to? Number one, when you look at the banks, maybe we've seen some buying of JP Morgan, but the majority of the post-earnings pops that we've seen in WFC, Wells Fargo, or Citibank, a lot of the pops faded away, and a lot of them are based on short covering. So folks short before the report comes out. If it doesn't come out as bad, they have to cover, and we see these names moving higher. But the money coming out of the big caps and the AI mania and the winners in industrials at least, it rotated in chasing the defense contractors within industrials. You look at LMT, you look at General Dynamics, GD, or Northrop, NOC, all positive on Friday's session. And some of that money chased energy. We see Exxon, Chevron, we see the natural gas names all moving higher on Friday. A lot of that money chased gold. If you look at metals, mostly negative because the dollar went higher, but we see gold miners positive. A lot of that money also chased defensive/safety, so long as bond yields are stable or going down. So we see utilities rebounding, we see the consumer defensives also rebounding. Of course, the insurance names remain hot, be it health insurance or PGR, Progressive. In financials, that's also moving higher. And then we look at the weight loss mania. Eli Lilly was muted on Friday, but NVO with yet another gain worth about 2%. Now, we also have sectors that are negatively impacted by the Israel news, mostly in travel. So we see anything airlines or cruises or hotels, casinos, travel services, bookings.com, for example, all down on Friday out of fears of the risk of escalation in the conflict. And of course, we see certain names with individual news. For example, the ticker BA for Boeing. That was down on Friday because of individual news regarding the MAX planes. And of course, Pfizer, down about 2.5%, and was down even more after hours when we got the news that they're reducing the revenue and earnings guidance. That stock is a disaster. They put all of their eggs in one basket, which is the basket of the virus with Paxlovid. And now they're lagging behind all of these competitors that moved on from the pandemic. When we contrast all of this with the weekly heat map, what do we see here? Believe it or not, the market was mostly positive. Some weakness in technology in the chips and the software names, but it's a mixed picture. Nvidia was down, for example, but AVGO Broadcom was up. Oracle was down, but Adobe was up. And you see the mixed signal across the board here in banks, some up, some down. In healthcare, of course, some up, some down. The majority of the downside came from medical devices. This is due to the Ozempic mania. And in contrast, of course, the leaders of the Ozempic mania, Eli Lilly, NVO, and now possibly AMG and Amgen. All winners for the week, massive gains here. The contrast is also clear in industrials. We see losers such as GE, FedEx, Boeing, but we see money moving into LMT, General Dynamics, Northrop, Raytheon, the defense contractors due to the war. In a week where yields are muted, we see utilities rebounding along with real estate. Metals down for the most part because of the dollar, but gold managed to stage comeback Friday. It of course comes hand in hand with energy, the winner for the week because of the geopolitical risk. And then we see some mixed performances here in defensives, in cyclicals, in communication services. So it was all over the board. But we have certain themes here, such as in healthcare, the Ozempic mania, the geopolitical risk. You see the defense contractors are up, energy is up, and of course, the retreat in bond yields. You can see that in utilities and real estate. When we switch to the heat map, for the ETFs for the week, what do we see here? Right off the gate, my eyes are on the TLT and the TMF. These are bonds, TLT and TMF up. Means that bond yields are down. Right off the gate, my eyes goes to yield-sensitive names, such as the XLU utilities or real estate, IYR, or consumer defensives, XLP, or positive for the week, be it the XLP lagging. And then we'll look at the ITB and the XHP, home builders and construction, also yield-sensitive, but be it negative for the week. And then, of course, we look at the geopolitical risk. We see that the majority of international equities were actually muted, with the exception of Brazil, the EWZ, and that's related to Petrobras and energy prices due to the inflationary risk out of this war. So we see energy, XLE, XOP, all outperforming, along with gold miners, the rush to safety, GDX, GLD, silver, SLV, all positive for the week. Now the question becomes, are we about to see the continuation of this theme when we see energy and gold and silver moving higher along with the defensives and utilities, for example? Or are we about to see the market changing the narrative here, saying, okay, maybe that we don't have a ground invasion right now, we have earnings coming out. All eyes should be on earnings, not on the Middle East, and I'm about to do something different here. If that is the case, then I believe we will see some of the gains coming out of energy, coming out of gold miners, coming out of silver. and maybe chasing some dips here in other sectors, maybe in healthcare, maybe following the theme in bond yields by buying more of utilities and real estate, or maybe all the way back to technology, the XLK and chips SMH. We'll see. But my hunch is the picture will be drastically different. Not necessarily in gains fading away from the winners, but for those muted sectors to make a move one way or the other, such as XLK Technology, XLP, Consumer Non-Discretionary, or XLV Healthcare. Let's do some charts here and wrap it up. We begin with the SPY, the S&P 500, an hourly chart. What do we see here? We marked a double top here in the hourly chart, and this is supposed to stick for a little while. We lost 433, a critical line, and now we're sitting at the support of 430. Forming a bear flag pattern. Understand this, whatever rebound we get overnight, if it doesn't go above 433 and stick above this number, then the bear flag is going to play out. And once we lose 430, a lot of selling will show up and take us all the way down, perhaps to 420. We look at the daily chart for the SPY. What do we see here? We have the 20 daily moving average in white, and that is still support. It is setting at around 431.14. And after that, we have the support of the 150 days moving average in blue, and that is setting at around 428.5. But again, losing 430 in my book will open the path to losing the 150 days moving average easily. Now, when we look at the weekly chart for the SPX, the cash index this time around, to give you some targets if you're trading the SPX, what do we see here? Number one, we see a pattern of lower highs and lower lows. We are below the 20 days moving average. So the assumption should be that we're going to see a continuation of the pattern of lower highs and lower lows. Until what? Until the chart beats the 20 moving average and climbs above the top of the breakdown candle that we can see from 2 weeks ago. But the other finding is we see negative divergence on the RSI. We see negative momentum confirmed here in the MACD and the Vortex indicator. So for now, the bears are in charge until, of course, the bulls turn the table and close on weekly basis above the 20 weeks moving average. Might have made a mistake and said the daily average, but this is a weekly chart. So the line in white is the 20 weeks moving average, not the 20 days. Now, what happens if the chart goes down? Then we have support number 1 at 4,200 and support number 2, if that doesn't hold up, at 4,000. If we look at the E-mini futures daily chart, what do we see here? Do we have damage? The answer is yes. We lost the support of 4,384.5. And that came on much higher volume than average. So it is a move out of conviction here. The good news, the momentum remains positive on the RSI and the MACD. The support of 4,350 is still here. So we don't see significant damage here. And what if the chart goes all the way down to 4,300? That's also okay, because it keeps the possibility of an inverse head and shoulder pattern intact. If we lose 4,300, then we begin to say, okay, the momentum is over here for the rebound, and down we go to make lower lows. If we look at the Qs, the NASDAQ, an hourly chart, what do we see here? We see a formation of a bear flag pattern. Support 363.85 and resistance at 367. Can the bull flag play out? Of course. And this should be the assumption right now. Until what? Until we see the Qs rebounding and recapturing 367 as support from an hourly chart perspective. Absent of that, whatever rebound we get will be short-lived and the bear flag will play out. If we look at the daily chart for the Qs, what do we see here? We do have significant damage here because we lost the 50 and the 100 moving average. Now we have the 20 days moving average at around 362.30. And if the chart breaks that, then we're going to see a lot of algos, a lot of quant funds dumping the Qs, and the chart will move down to make lower lows. We look at the weekly chart for the NDX. A lot of you trade the NDX, so we have to look at that. We closed below 15,000, a critical level that should have been lost. But the good news is the NDX is now sitting on a trend line of support on the weekly chart. But if we look at the closing and the shape of the candle, it is just a matter of time here before we see the NDX breaking the support of this trend line. So it becomes really imperative for the bulls to close the NDX above 15,000 on weekly basis. Otherwise, we're going down. If we plug in the Fibonacci levels here, what do we see? We see 14,636 as the important number. We break below that, then we go down to 13,834. If we use the Bollinger Bands and the 20 moving average on the weekly chart, we see that we're below the 20 average, which is bearish, not bullish, and we had a failure to close above. This further supports that this chart wants to go down, not up. When we look at the daily chart for the NQs, the NASDAQ futures, what do we see here? We see a rejection at the top of the breakdown candle, but do we see significant damage here? The answer is we see some, and the reason is the volume was much higher than average on down days, indicating that perhaps we have more downside momentum coming here. But the good news is, at least for the bulls, the momentum remains positive looking at the RSI and the MACD, be it decelerating. But perhaps the best good news for the bulls is the fact that 15,000 is still intact as support. Once we close below 15,000, then we got a problem here. We have a revisit to the double bottom formation. If that's lost, then we have lower lows to come, and it could initiate a flush down scenario. We look at the IWM small caps daily chart. What do we see here? We stopped at the 20 days moving average in white. We lost 175.45 as support. The momentum is now turning negative. We have 169 as the last line of support in the daily chart. And it appears that the IWM is heading that way. The IWM doesn't become bullish again or a buy again without closing above the 20 days moving average at around 175.40 now. Otherwise, the assumption should be that 169 is on the cards now. And if we switch to a weekly chart for the IWM, we can see that after that we have 162.5, but then it's over. You gotta break and have all of that energy released in a crash scenario. So the last line of defense here for the IWM is 162.5. We look at the dollar and we begin with the daily chart here. What do we see? We see that the dollar managed to rebound right below the 20 days moving average. And this is typical behavior from the US dollar. It plays tricks. It shows that it's dead, and then it rebounds and recaptures the 20 days moving average. If we zoom in to an hourly chart, what do we see here? We see that we still have a bull flag consolidation pattern, and the assumption should be dollar is going higher, absent of breaking the support of 106.196. On the weekly chart, the dollar put in a topping pattern last week. But of course, we know that the dollar is named Tricky Dixie. It plays a lot of tricks, it plays dead, then it comes back. And this week it managed to close above the closing from last week. Can we say that this is a reversal? Yes, it is for now. And this is supposed to be bad for gold. But if we look at the daily chart for gold, we got a massive pop on Friday. The divergence is happening because on Friday we got a rush to safety because of the war. Now, if things cool off a little bit in the Middle East front, we could see gold flushing down. And this is why for now, I'm not going to be chasing the move here in gold. I'd like to see how long and how persistent and resilient gold is in fighting the dollar. And if it holds for another week where we see the dollar moving higher, but also gold moving higher, then we can say, okay, gold is now seeing something different that is more important than the negative correlation with the dollar. If we look at the GLD, the weekly chart, it is now facing the resistance of the 20 moving average in the weekly chart. My hunch is we have seen an overreaction in gold on Friday's session, and those gains will be trimmed, at least for now. If the conflict escalates and we see the ground invasion, then it could be an opportunity to buy the dip in gold. But for now, chasing it right here is a little too risky. Silver, SLV, daily chart, what do we see here? Nice pop on Friday. The momentum is positive, above the 20 days moving average, but if the move was based on overreaction or panic or a lot of fear, and the fear subdues, then SLV will go down. Then it becomes imperative that 20.27 is held as support. Because if that's lost, sure, you can lose the 20 days moving average, then climb it back. No problem here. But if you lose 20.27, it tells me it was a knee-jerk reaction on Friday, and SLV will go down in coordinates with the negative correlation with the dollar. When we look at the daily chart for UK oil, aka Brent oil, what do we see here? We talked about a bull flag formation on Thursday. We got a pop on Friday, and the pop got us above the 20 days moving average. That is bullish enough for oil bulls to keep us holding and adding here. If it happens that oil loses the 20 days moving average and then reverses the entirety of the move from Friday, then we know for sure that we got the top in oil, and that was back in September. And from this point on, we're going down. But for now, the assumption should be energy is going higher. So we look at the energy ETF, the XLE. A lot of us bought the dip here when energy prices went down. And for now, we are rewarded because the important supports are kept and the important resistance has been broken, which is the 20 days moving average. The momentum appears to be turning positive. We're looking at the RSI or the MACD indicators. So for now, we should be holding on the XLE. The XOP did a little better due to the exposure of natural gas. So we see the XOP now comfortably above the 20 days moving average and actually showing bullish momentum in the RSI and the MACD indicators. When we look at the daily chart for the 2-year yield, what do we see here? Believe it or not, did a lot better than the 10 and the 30, so we saw a little bit of inversion in the yield curve in Friday's session. If we continue to see the rush to safety in buying the 10 and the 30 bonds because of the war, then my hunch is we could see re-inversion again, with the 2-year outperforming the 10 and the 30. But what I believe right now is Friday is the exception. We saw buying of bonds, but again, if you're looking for safety and security, because of the geopolitics, you got gold, you got silver, you got the VIX, you got the dollar, you got defense contractors, you got oil. You don't have to buy bonds. And this is why I think that the buying of bonds will revert back into selling. We will see yields moving higher again. And that is because of the inflationary dynamic. If we look at the 10-year yield daily chart, what do we see here? Caught a rebound of the 20 days moving average. That is support, and it is holding for now. If we look at the hourly chart, we see that we have a lower high, but again, that's all because of the war. If we have a delayed ground invasion, we should be seeing a recovery here in the 10-year yield. The question now becomes what happens to the TLT. The TLT is okay so long as it holds support, as you can see in the chart here. If it loses support, which is the top of the consolidation candle, then we know that the 10-year is going higher and the bounce in the TLT is over. Now, we see a lot of buying of the TLT, but they've been buying because we have a lot of bears who believe that a systemic crash will happen, that a recession will happen right now, and they have to be prepared and buy these bonds ahead of time. The problem is you can't really time the recession or the credit event. So it could be the case of catching a falling knife until that happens. Then we'll look at yield-sensitive names such as the XHB, the home builders. It went down on Friday again, albeit the 30 and the 10-year were muted. But now if we see these rebounding, meaning the yields in the 10 and the 30, then the XHB has some support at the lows there from the rebound. Now if it breaks all of these lows, then we will see the momentum turning negative. We will see acceleration of selling here in the XHB, and I believe that this will be the case, folks, if I had to bet one way or the other. We look at the VIX daily chart. What do we see here? We got a big pop on Friday, but is it an overreaction, just like we've seen with bonds, perhaps, or gold? It is a good question, but understand that the VIX has more dynamics than gold and bonds. Both were bought based on geopolitical fears. The VIX was bought, meaning buying puts on the S&P, because of geopolitical fears, in addition to earnings fears. And this is why I see the rebound in the VIX as more sustainable here. If we clean up the chart, we have a double bottom. That could be a reliable bottom for now, meaning we're not going to go down to these levels again. And it could be also within a larger cup and handle formation. Another way we can look at it is an inverse head and shoulder pattern. So we have a lot of confirmations here that the VIX should be going higher, not lower. The Big Kahuna Apple hourly chart, what do we see here? We got the inverse ABC pattern playing out. We lost support. And now we have consolidation in a bear flag pattern. Confirmation will be losing 177.35 for support. But we have to look at the daily chart here to identify the risk. Number one, we got a rejection off the 100 days moving average and the top of the Bollinger Bands. If we plug in the 50 days moving average now, then we can say that we have support, and that is 177.89. If broken, then we have support of the 20 days moving average at around 175.5. If that's broken, then we're going to see the algos, the quant funds, a lot of the holders adding a lot of pressure here and rushing to the exit door at the same time. Tesla daily chart, what do we see here? It lost the support of the 20 days moving average in white and now sitting at the support of the 100 days moving average at around 250. We also have the support of the 50 days moving average also around 250. So we know that 250 is a critical number here for Tesla. To begin with, it appears that we have a formation of a lower high yet again. Will it lead to lower lows? Well, the confirmation for that would be losing 250. If we zoom in to an hourly chart, what do we see here? We see the chart oversold. I would not be surprised to see a rebound, at least right off the gate on Monday. It could be a gap and crap at the end of the day, but my hunch is we see a lot of de-risking here as we head to the much anticipated earnings report by Tesla. It is a story about margins. Everybody wants to see how it's going to play, and we have a lot of fears. So I would say any rebound in Tesla here will likely be faded until the report comes out. And of course, losing 250 and closing below 250. And then we get an ugly report, for example. It could accelerate the move to the downside because the quant funds, the algos, will join the selling here below 250. It could be an ugly week for Tesla if they miss earnings in a big way. If we look at the weekly chart here, what do we see? We have the chart sitting exactly at the 20 weeks moving average. If it breaks that, then we have more downside to come. And we have warning signs here, folks. We have negative divergence on the RSI. We have negative momentum in the MACD indicator. We have negative momentum showing up now in the weekly Vortex indicator. And what about NVIDIA daily chart? What do we see here? We got a rejection and a reversal from the top of the Bollinger Bands, but without confirmation because the 50 days moving average support is still intact in blue, and the 20 days in white is also still here. Now, if we clean up the chart and plug in my support lines, we can see that we have a formation of a head and shoulder. And we lost the support of 455.80. Can we go down to the support of the trend line? Of course, that is a possibility. But the most important chart in NVIDIA here is the weekly chart. And when we look at that, we can see that we're above the 20 weeks moving average. And this support line has never been broken this year so far. Maybe we got a touch below, but never been broken decisively, which means if it is broken, and we close decisively below the 20 weeks moving average, it would be a conclusion that the top is already in. We could see massive declines to come in the stock. The RSI is in negative divergence, the MACD is in negative momentum, the Vortex indicator on the weekly chart remains positive for now, but it is fighting a really strong bearish momentum that my gut would say, and my eyes would say, that will take over and the 20 moving average will be lost. And lastly, tulips, Bitcoin. What do we see here in the daily chart? We see that it caught support at around 26,555, but it is within a bear flag formation pattern. So the assumption for now should be Bitcoin will go down, regardless of the rebounds. Until what? Until we see a pattern of higher highs. Absent of that, BTC is going down. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Beginning Monday, October 16, we have the Empire State Manufacturing Survey, along with the zombie from Philadelphia Harker. We don't really care what the Fed says anymore. They're not in charge. Tuesday, October 17th, we have retail sales, industrial production, capacity utilization, and we have business inventories, the Home Builders Confidence Index. And then we have a bunch of Fed zombies from Governor Bowman, Richmond President Barkin, Minneapolis Fed President Neil Kashkari. Again, who cares? They're not in charge, folks. Inflation is. And then Wednesday, October 18th, we have housing starts and building permits on top of Governor Chris Waller and New York Fed President John Williams, Governor Lisa Cook, and the Fed Beige Book coming out on Wednesday. Thursday, the 19th, we have initial jobless claims. We have the Philly Fed Manufacturing Index. We have existing home sales, leading economic indicators. That comes on top of the big dog, Jerome Powell, speaking on Thursday. And he's going to be followed by Chicago Fed President Goolsbee, Vice Chair Michael Barr, Atlanta Fed President Bostic, and Dallas Fed President Logan. All of these zombies, along with the big zombie himself, Powell, they don't matter anymore. So there's no wonder that on Friday, October 20th, when we hear from Cleveland Fed President Loretta Mister, it's not going to matter really. Friday, the major event would be OPX, options expiration, the major potential here for a lot of volatility to show up. So all I got to say, folks, is buckle up. We got a lot to talk about this week. So once again, join us if you can. We have a lot of videos, including earnings coverage, coming out from the members this week. So join or die. But with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
You can't handle the truth.